The 2027 Wealth Transfer, How to Position Yourself Now. Part 1. The $84 trillion Mirage. Imagine a stick man named Alex. Alex is a 32-year-old millennial living in the year 2026. Alex is working hard, but he feels like he is running on a financial treadmill that is moving faster than his legs can carry him. However, Alex has a plan. He has been reading the headlines about the Great Wealth Transfer. According to the latest data from sources like Vanguard and Cerulli Associates, over $84 trillion in assets is expected to be inherited by millennials and Generation Z by the year 2045. This is the largest movement of capital in human history. Alex looks at his parents' fully paid-off suburban home and their robust retirement accounts and thinks, "I just need to stay the course. My financial freedom is inevitable once that inheritance hits." But Alex is performing a faulty forensic audit of his future. He is ignoring the invisible erasers that have already begun to scrub away his projected legacy in the year 2026. Our audit of historical wealth patterns reveals a chilling reality. Approximately 70% of wealthy families lose their fortune by the very second generation. In the world of 2027, the system has been re-engineered to ensure that passive heirs are harvested before they can ever become sovereign owners. The first eraser is Alex's own psychology. Because of the promise of this $84 trillion windfall, 36% of Generation Z and 29% of millennials have admitted they are no longer focusing on saving for their own retirement. They are essentially setting their own financial houses on fire because they think a golden fire truck is coming to save them. This lack of a personal tactical buffer makes them fragile. If the transfer is delayed by just 5 years because of increased life expectancy, Alex will be 40 years old with zero liquid capital and a decade of lost compounding. The second eraser is architectural disconnect. Alex assumes that a traditional paper will is the master key to his parents' kingdom. But in 2026, under the revised Uniform Fiduciary Access to Digital Assets Act, RUFADAA, the law has established a new hierarchy of power. If Alex's father has not set up the inactive account manager on his primary accounts, the online tool legally overrides the paper will. The family photos, the business domains, and the private keys to any cryptocurrency are not inherited. They are often legally purged or locked behind biometric doors that the probate court cannot open. Alex isn't waiting for a fortune. He is waiting for a series of access denied screens. Today, we are performing a surgery on the 2027 Wealth Transfer. We are going to look at why the One Big Beautiful Bill Act, OBBBA, created a temporary tax sanctuary that is about to close, why the Senior Bonus Deduction phase-outs are eating into your parents' ability to gift assets, and why you must implement the positioning protocol immediately if you want to be the owner of that $84 trillion instead of its victim. Part 2. The Evaporation Math and the $15 million Smokescreen. Alex is waiting for his share of the $84 trillion, but he is staring at the wrong set of numbers. In the year 2026, the mainstream media is obsessed with the headline-grabbing changes in the One Big Beautiful Bill Act, or OBBBA. They talk about the estate tax exemption being raised to a permanent $15 million per individual and $30 million for married couples. To Alex's parents, Sam and Sue, this sounds like a total victory. Their net worth, including their home and retirement accounts, sits at roughly $2 million. They think, we are nowhere near the $15 million line. Our legacy is safe from the government. But our forensic audit of the 2026 fiscal landscape reveals that the system is no longer interested in waiting for you to die to harvest your wealth. The government has pivoted from legacy extraction to duration harvesting. They are using a silent tool called Fiscal Drag to erode the corpus of Sam and Sue's estate while they are still alive. Fiscal drag occurs when the government freezes or slowly adjusts tax thresholds while inflation pushes nominal values higher. In 2026, the cost of maintaining a standard lifestyle has climbed by 27% in just a few years. While Sam's pension and Social Security have seen modest cost of living adjustments, the tax brackets they fall into have become mathematical cages. Sam decides he wants to help Alex with a down payment for a house. He plans to use the Annual Gift Exclusion, which for 2026 allows him to give $19,000 per person without even filing a tax return. But here is the catch Sam didn't see coming: the Senior Bonus Deduction Trap. Under the OBBBA, Sam and Sue qualify for a new $12,000 deduction because they are both over 65. However, this deduction begins to disappear at a violent rate of 6% for every dollar they earn over $150,000 of modified adjusted gross income. To Sam, an extra consulting project or a larger withdrawal from his traditional 401k to fund Alex's gift seems like a good idea. But the moment his income crosses that $150,000 threshold, he triggers a tax collapse. He isn't just paying the 24% marginal rate on that extra money. He is simultaneously losing the very deduction that kept his living costs manageable. The math is brutal. To give Alex $19,000, Sam might have to pull $25,000 from his accounts, pay higher taxes, and lose his senior bonus. The great wealth transfer is being taxed at the source through the income realization window long before the probate court ever gets involved. Furthermore, Alex is ignoring the Williams Group study, which found that 70% of wealthy families lose their fortune by the second generation. This isn't because the heirs are lazy. It is because the architecture of wealth in 2027 is designed for liquidity traps. Sam and Sue are house rich and cash poor. They have $1 million in equity in their suburban home, but that equity is dead capital. It cannot be easily moved, it produces no income, and it is subject to rising property taxes and insurance premiums that act as a holding tax on their legacy. By the time Alex inherits the house in 2045, the cost of carrying that asset for 2 decades may have consumed 40% of its total value. The system wants Alex to be a passive recipient, waiting for a check that is being eaten by 1,000 small bites. Today, we are going to look at why your parents' forever home is actually a wealth prison, how the new charitable itemizer floor of 0.5% of income is killing the bunching strategy, and why the only way to save that $84 trillion is to move from inheritance to active allocation. Part 3. The Positioning Protocol and the Architecture of Sovereignty. To save the $84 trillion from the invisible erasers of the system, Alex and his parents must stop acting like passive heirs and start acting like sovereign capital allocators. Our forensic audit of the One Big Beautiful Bill Act and the RUFADAA legal framework reveals that the only way to win in 2027 is to build a financial foundation that the algorithm cannot easily harvest. Step 1. The MAGI Suppression Strategy. The greatest threat to Sam and Sue's ability to fund Alex's future is their Modified Adjusted Gross Income, or MAGI. As we analyzed, the $6,000 senior bonus deduction is a mathematical lure. To keep it, Sam and Sue must pull their income back below the $150,000 red line. The most powerful tool for this is the Health Savings Account, or HSA. In the year 2026, the family contribution limit has risen to $8,750, with an additional $1,000 catch-up for each spouse over the age of 55. By maxing out their HSA, Sam and Sue perform a double tap on the IRS. They lower their taxable income dollar for dollar, shielding their senior bonus, and they build a tax-free vault for future medical costs. For Alex, this is critical because every dollar his parents save on taxes is a dollar that eventually flows into his inheritance instead of the government's coffers. Step 2. Implementing the Digital Death Protocol. Alex assumes that because he is Sam's son, he will naturally inherit Sam's digital kingdom. He is wrong. Under RUFADAA, If Sam has not specifically used the online tools provided by the platforms, the loop will close on his assets. Sam must immediately set up his inactive account manager on Google and his legacy contact on Facebook. These designations act as a Tier 1 legal directive that overrides his physical will. If Sam has cryptocurrency, he must move beyond paper sovereignty. He needs to implement a trust model where his private keys are held within a revocable living trust. The trust agreement must name a digital executor, someone who isn't just a relative but a technically competent fiduciary. This person is granted the legal authority to bypass two-factor authentication and manage the sovereign cryptocurrencies like Bitcoin and Ethereum. Without this architectural setup, Alex will be staring at a $15 million inheritance on paper that he cannot access in reality because the biometric key died with his father. Step 3. The active allocation pivot. The most dangerous thing Sam and Sue can do is wait for the $15 million estate tax line. The system wants you to wait for death because that is when you are most immobile and harvestable. The positioning protocol requires Sam to use the Annual Gift Exclusion aggressively. In 2026, Sam and Sue can each give Alex $19,000, a total of $38,000 a year, with zero tax reporting and zero impact on their lifetime exemption. Over 5 years, they can move nearly $200,000 into Alex's hands. This isn't just about moving money. It is about duration arbitrage. If Alex puts that $38,000 into a diversified index fund, he has 40 years of compounding ahead of him. If he waits to inherit it as part of the Great Transfer in 2045, he loses 20 years of the most explosive growth. By gifting now, Sam is essentially pre-funding Alex's sovereignty and removing that capital from the reach of future fiscal drag and property tax escalations. Step 4. The bridge account handshake. Finally, Sam and Sue must help Alex build what we call a bridge account. This is a taxable brokerage account designed to bridge the gap between when Alex wants to retire and when he can access traditional accounts at age 59.5. In the year 2026, the system is designed to trap you in age-restricted buckets, like the 401k. By funding a bridge account for Alex now, using their gift exclusion, Sam and Sue are giving Alex the one thing the $84 trillion Mirage doesn't offer: strategic optionality. He no longer has to wait for a normal retirement. He can walk away from the rat race whenever his bridge account beats his cost of living. Part 4. The final audit and the sovereignty. Conclusion. Alex started this journey looking for a check that wouldn't arrive for another 20 years. But through our forensic audit, he has realized that the $84 trillion Great Wealth Transfer is not a destination, it is a systemic flow. If you wait at the end of the pipe, you only get what the filters haven't caught. If you move upstream and own the pipe, you control the flow. The psychological trap of the inheritance mirage is what I call legacy dependency. When Alex relies on his parents' capital, he subconsciously lowers his own exit velocity. He becomes less aggressive in his career, less disciplined in his savings, and more compliant with a system that treats him as a future harvestable resource. He is essentially living on borrowed sovereignty. And as we have seen with the RUFADAA hierarchy and the OBBBA phase-outs, that sovereignty can be revoked by a single algorithmic update or a missed legacy contact setting. To truly position himself for 2027 and beyond, Alex must realize that wealth in the barbell economy is architectural. It is not about the amount of money you have. It is about the structure in which that money sits. By implementing the positioning protocol, Alex and his parents have shifted their $2 million estate from a passive target to an active fortress. They suppress their modified adjusted gross income using health savings accounts, saving thousands in taxes and protecting their $6,000 senior bonus. They utilize the $19,000 annual gift exclusion to move capital out of the reach of future fiscal drag and property tax escalations, buying Alex decades of extra compounding time. They secured their digital legacy by appointing a digital executor and overriding the terms of service trap through RUFADAA-compliant online tools. And they built a bridge account, giving Alex the strategic optionality to retire whenever his portfolio beats his carry costs, rather than waiting for a government-mandated age. Alex is no longer a stickman waiting for a miracle. He is a sovereign capital allocator. He has moved from the resource column of the bank's balance sheet to the owner column of his own. The sign-off. The world of 2027 will be defined by the largest transfer of wealth in history. But it will also be defined by the most efficient extraction of wealth in history.
The system wants you to stay passive, stay dependent, and stay immobile. They want you to stare at the $84 trillion headline while they quietly harvest your MAGI and lock your digital vault. Don't be a victim of the mirage. Audit your legacy, position your capital, and build your own bridge to freedom before the system erases your future. If this forensic audit of the wealth transfer changed how you see your inheritance, hit that subscribe button. We are dissecting the hidden equations of the 2026 economy every week to help you stop being the crop and start being the owner. I'm Joe from fin.stickman, and I will see you in the next one.